welcome all. Welcome to the next webinar on intricacies of intercorporate loan and borrowings. And we have with us today our own Anshu. Anshu, again, thanks a lot for your time, because nowadays it's a peak season and for you also the same way, but you have taken out time. As Sudhakar insisted you, I respect your that commitment. Thanks a lot. And we have our own Sudhakar, as you know, people, and I did not introduce Sudhakar, and our own Bala. And today, for a change, Anshu herself is presenting. Thanks, Anshu, for that also. Anshu Agarwal, let's give a brief profile. Even many people knows her because she's also a regular speaker on a various public forum and good friend of us since years. Anshu Agarwal is a BCom and law graduate and is a fellow member of the Institute of our Company Secretary, ICSI. She has over 17 years of experience in the field of various corporate laws, merger and acquisition and fundraising activities. Prior to joining Borosil, she has worked with the business groups like Reliance Industries Limited, Reliance Infrastructure Limited, IIFL and Loda Group. Presently, she is working as a group company secretary of Borosil Group. She was also a member of Corporate Law Publication Committee of ICSI and a regular speaker at various forums. Anshu, thanks a lot for your time. Welcome to our session. Anshu, I will request you to say a few words on the topic, and then I'll request Sudhakar and Mr. Bala to say, and then, or otherwise Sudhakar will say a few words and then Mr. Bala, and then you can start your presentation. Thanks. Over to Sudhakar.
Yeah. Thank you very much, Dipti, and good morning, everyone. Hi, Anshu. Thanks for joining us today. And friends, that this particular topic you discuss as many times as you want. Still, it is a fresh topic and having a lot of what's called as complexity in understanding the sections. Initially, long before, we used to have section 370, 372, and subsequently the same has been transformed into 372A. Now it is 186. If you see, I think if I'm not wrong, 85% of the section, the provisions remains the same. Only 15% changes there. But even till date, the understanding, according to me, for the fraternity colleagues is still lacking. The interconnectivity between section 186, 185, as well as the interconnectivity between 186 and 179, or I mean, the kind of clarity what should have been there, according to me, it is not there. Because whenever I go as a faculty on this particular topic, the amount of questions what they come, sometimes I feel there are two elementary questions, Might be there are certain sections in Companies Act, both in 56 as well as 2013. I used to give them, tell them as well as they're always evergreen sections. You go on, taking a deep dive as much as you want, but still you will not find the perils, So this is one such section, and I'm sure because Anshu worked with me for quite some time, so I know her. She got a good expertise as far as these two particular sections are concerned, and I'm sure that she alone can handle the questions and all. We don't require as such today, but still wherever we require, we'll step in there definitely. I give a pause here and request Bala to say a few words, and after that Anshu will take over. Thank you.
Good morning to all of you. I have a great pleasure in welcoming you all for today's session on my own behalf and also on behalf of Mehta Mehta. As Sudhakar has put it, when we talk about the loans and the borrowings, etc., and other things and all, question actually comes to understand certain intricacy of the word. The word which are used in the section itself is directly or indirectly. What do you mean by indirectly? When we say indirectly, we normally tend to think that things are done through the intermediary agencies, and it is actually given roundabout the way. That's what we actually think. Now the question is, a flat is being sold to a director. The condition of the sale is actually partly cash, partly credit. Because it is partly credit, can it be actually turned as a loan? Question. I think there have been settled cases on this issue, on this thing. When we go along, we will actually see. Similarly, when we talk with the director, Then again, the definition of the director is so large. It includes the lending company and the holding company and the partner of any company where the director is the partner, relative of the partner, firm, partner in the firm, all such things which are existing. Again, this section cannot be read alone as 186. We will also look into the compliances which are required under section 185, 179, and 188, etc., wherever it is required. And again, coming to loan, what is not intended to be a loan, whether the loan can be converted into a loan, that is another question. Because normally if there is a debt is there, if the debt is there actually there, which is intended as given as a debt, but can this debt which is given can be said to be a loan? There are also decided case laws there. What is not intended to be a loan cannot be compulsorily converted to the loan. There are decided case laws is also there. And many times what happens is directors, they also tend to give in his personal capacity, guarantee and surety, etc., and other things, and all the things, exposing themselves to a greater risk. In fact, there is specifically, I cannot see anything in the acts and rules, but there has been a clarification long back issued by the MCA in the year 1976 itself, that such directors are actually advised not to get actually involved in these activities, which will actually expose them in providing the security and guarantee, etc., and other thing and all. There is a clarification notice also there. Again, extending the credit, whether that will amount to the loan. All these intricacies are actually there. So naturally, today I think Anshu is going to take us over all the things. We'll get the clarification, as much as clarification. But as he said, the topic is very vast. N number of times we keep on reading, we get the new interpretation. We still think, are we thinking right or wrong? All such questions comes again. And again, what happens is wherever the limits, again, which normally happens with the private company and limited public companies, the limits actually exceeded up to what extent the loan, etc., can be given. Then again, it's called the resolution, the special resolution is called for MGT 14 required to be filed, etc. Invariably, that is also missed out from the compliance part of it. Again, there are various disclosures which are actually called for in terms of the financial statements, even in the board reports, etc. And again, the question may also come when we are talking what is permitted, what is exempted, what is restricted. I think she is going to take us through on all these issues. Because the question is interpreting the law is very, very important. Because when we go to the section, it says at the time of giving the loan, which means an employee who has got a loan, he becomes a director subsequently. Whether the loan which is actually earlier given, whether it is continued to be exempted as a not part of the loan, or it will actually also cover as a loan, that is again another question which is open for discussions. I think with all these nitty-gritties, I think Anshu Agarwal is going to take us through, and we will know more about it. I request all of you to interact, raise your questions wherever you feel, seek, wherever you feel, you can raise your hand, you can also talk to us, and we will try to understand between us so that it is totally a knowledge enhancing session. Personally, I look forward to hear from her. Thanks a lot. Over to Anshu Agarwal.
Thank you, sir. Thank you. So let me firstly thank you, Team Mehta and Mehta, Dipti ma'am, Sudhakar sir, Mr. Bala, and rest of the team members of Mehta and Mehta for inviting me for this session. It's really a sheer pleasure taking this session in this forum. So thank you once again. Thank you, ma'am, for giving my introduction. And now talking about this topic. So this topic is also very close to my heart, and quite an interesting topic, as Sudhakar sir and Mr. Bala talked about it. Quite an interesting topic, and a lot of critical points to discuss on this, both the topics, that is section 185, 179, 186, and so on. So I'll try to share my views and also take your views on these topics, and then we will deliberate on it. So moving on to the topic, let me first just give a brief, like 185, and when we say intercorporate loan and investment, we are going to talk about when the company is giving loan, giving security, making loan, okay, making investments. It's not about taking. Okay, a company can take or company can give. So what we are going to talk about is when the company is making investment, giving loan, giving security or guarantee. Okay, so let's begin with section 185. I'll just display my presentation.
Yeah, visible.
You all can see my screen?
Yeah, very much, very much.
Oh, okay, okay. And I'm audible properly, right?
Yeah.
Yeah, okay. So just as a small disclaimer to everyone that whatever I'm going to speak and share my views is my own personal view and does not represent to the organization I presently work or have worked in the past. These are my own personal views. The topic of the discussions, the flow will be, firstly, we'll discuss about section 185, loan to directors and parties in whom directors are interested. And then we'll talk about 179 followed by restriction 186.1 that deals with layering of subsidiaries, and about 186.2 which deals with intercorporate loans, investments and guarantees. And we'll also take the questions and doubts, if any, in between. So let's begin with loan to directors, section 185, right? As we said, when it comes into picture, when a company wants to give loan, either to a director or the persons or entities in whom the director is interested. This section had come into force right from 12 September 2013, and there was a quite a lot of, the whole of section was amended, and it amended in the last 2-3 years before, I don't remember the exactly, I think 2017, but it is applicable to all the companies. Unlike section 295 under 1956 Act, this section, the way it is now, is applicable to all companies, public and private. Of course, there are certain exemptions by virtue of 2015 and 2017 exemption notifications for private companies, but it is subject to certain conditions. We'll deal with it. But principally, this is applicable to both the companies, be it public, be it private, be it listed, or any kind of size of the company. For the sake of discussion, we will summarize section 185 into 3 categories. One is prohibited, the other category will be regulated category, and the third is totally exempted. Okay, as you can see on the screen, first bullet is about prohibited category. So I'll deal with each of these categories in subsequent slide, but principally we will bifurcate the whole of section into these 3 broad categories. Prohibited is one which you cannot give. You cannot take board approval, you cannot take central government approval, you cannot take shareholders approval, no approval, no, it's not possible. It's totally prohibited. You cannot go to anybody and take approval and give loan to these categories. Second one is regulated category. You can give loan to the persons and entities falling in this category, regulated category, but with due procedure. Third is exempted, which is section itself exempts these categories. So let's go in more in detail about these 2 categories. Firstly, prohibited category. So as you can see, no company shall directly or indirectly. Mr. Bala briefly touched upon indirectly, on the word indirectly. Okay, so what is indirectly? What a company cannot give on its own because of the restrictions. The company decides to route it through someone else. Say company A wants to give loan to its director and there is this section and you are not able to give. So you decide to give some third party, say company B, which is not related to you maybe. And then you request that company, I have given you loan and you please pass on this loan to this particular person who happens to be your director. So that is one example of indirect, or maybe through anybody else. Okay, but what you cannot do directly, you are trying to do it indirectly through some person or intermediaries. That is covered as indirectly. So what are the transactions which get covered under 185? Loan, including any loan represented by a book debt. What is book debt? So we all understand what is loan, but what is book debt? Book debt is, let me give an example of book debt. Say there is a credit card, personal credit card of your director, and the company pays the credit card of that director on behalf of the director. Company is paying the personal bills or the shopping expenses of the wife of director. Okay, credit card, personal expenses, education expenses of the son of director. So all this, so this is indirectly and specifically book debt. Say again coming to, so there was a personal credit card required to be paid of director, and the company has paid that bill of credit card. So isn't it a kind of book debt that, or we'll deal with more examples of book debt in subsequent slides, but it's not only restricted to loan, but also something which is a book debt which is payable by the director to the company, not exactly trade advance, but which the director was required to pay to a third party and the company has paid on behalf of the director. Or give any guarantee, provide security. So loan, guarantee, security. Here is the word in connection with the loan taken by. So you can see the word guarantee or provide security in connection with loan. I'm supplying emphasis on in connection with loan. So the guarantee and security should be in connection with loan. If you're giving some guarantee which is not in connection with the loan, say let's take an example, performance guarantees. Performance guarantees are outside purview of section 185. So you have to take into account the words which is used in the section in connection with any loan. So loan, guarantee or security on behalf of whom, now we will deal with that one by one. To whom? A director of the company or of a company which is its holding company. So the section does not only restrict to director of the company, but also of a company who is the director of the holding company. There could be a layer structure that the company does not have only one holding company, but it also has a holding company above holding company. So it will restrict not only to the director of that company, but all the directors, all the holding companies directors, maybe it 1, 2 or more. Any partner of any such director. So partner of director or the holding company's director, why I'm extending it to the director of the holding company? Because you can see the wording here is any partner of any such director. We have to interpret the word such director used here, such director. And if you see in detail the wording, the way such and the placing of the word such director, we have to interpret such director not only to the director of the lending company, but also of the holding company of such lending company. So third category is any person who is a partner of the lending company's director or the holding company's director's partner. Fourth category is again relative, both lending company and holding company. And lastly, a firm in which any such director, so that is again lending company and holding company, or a relative or any of the relative of the directors is a partner. So as you can see here, clause 1, 2, 3, 4, 5, director, holding company director, partner of such directors, relative of such directors, and lastly the firm. All these 5 categories, a company cannot give loan even after taking any approval. As you must be aware that the requirement of taking central government approval or the option of taking central government approval is totally removed from the section. There is no such option available now. And so in this section, this is totally prohibited. It basically deals with all individuals, that is director, holding company director, and their relatives and partners, and also the firm. And the firm, not only the director, but even their relatives are partners, that also firm is prohibited category. So this was all about prohibited. Just one clarification here, that genuine trade advances. Say the director of your company is into some business and your company is buying that material which the director is engaged into, buying a raw material from that director. And you have to pay for that raw material which you have to purchase from that director or the entity which belongs to that director. So will you say that this payment to that director or the entity for this purchase of raw material will attract section 185? No, this is a pure trade transaction, that you have purchased certain goods from that director and you are paying for it. And whatever is the normal credit period involved, you are paying within that credit period. So this is purely a trade advance. There could be many such examples. Say your director has particular premises, office premises, he is owning it, and your company has taken it on rent, and you're paying that rent to that director. Again, this is a trade transaction, and it has nothing to do with the loan, and these transactions will be outside purview of Section 185. It is purely a loan transaction or book debt, so something you are doing to lend. Okay, pure business transactions which are in the ordinary course in the business of the company would be outside purview of Section 185.
Anshu, one question always comes is that, as you rightly mentioned in the prohibited category, the giving loan to a director of a subsidiary company is not prohibited.
Right,
giving
sir.
Loans to the directors of associate companies is not prohibited, whereas giving loans to the directors of the holding company is prohibited. What is the rationale for that?
So, sir, in my view, why that is not covered is that subsidiary companies directors are not maybe that the holding company director is influencing the subsidiary company to give the loan, but that cannot be the case for your subsidiary company director. You say company H and it wants to give loan to S Limited. It is very unlikely that board of directors of S Limited can influence board of directors of H Limited to give loan to S Limited, and that is why it is not prohibited. So the intent of this section is that why is this government tries to regulate this giving loan to a director is that directors who are taking decisions on behalf of a company, they should not be abusing this power, their powers, for giving loan to themselves or their relatives. Okay, look, so in a way they are trying to favor themselves, and they are sitting in the capacity by virtue of which they can take decisions. That is the intent of this section.
I would think, Sudhakar, father is supposed to look after the son. So holding company is supposed to look after the subsidiary, not vice versa.
Yeah.
Yes. I agree with you, Anshu.
Yes. So that is the thing. Whereas the holding company directors, there could be scenario, not always, that they are trying to influence the subsidiary company's board, and by virtue of that, maybe the reason that it is covered. So we have to read here what such director very carefully and take a view that holding company directors, in my view, will always be covered in this restriction. Moving on to further a little more on prohibited category, we discuss. So there is as Mr. Bala also mentioned briefly about what is not a loan cannot be converted into a loan. There is a very classical and famous judgment of Dr. Mehta versus Union of India. Just giving very brief about the case law. What had happened in this case, that a director of the company had purchased certain immovable property, certain flat from the company. And it was agreed, there was a board resolution passed for this to this effect, to sell this flat to the director of the company. It was agreed by the board of directors that he would make payment towards this purchase of immovable property, 50% right at down payment, and the balance in 2-3 tranches. When in between there, after this, when he was, there was a ROC inspection on this company, and the ROC has alleged that the company has violated Section 295, that is loan to director. They said that the balance amount which the director was supposed to pay in installments is nothing but a loan, was the allegation of the department on the company. The case went into the courts, and it was finally decided that this transaction, as in this example, was what? The company had sold the immovable property, the flat, to the director. And so it was agreed that he will pay the balance. It was never that the company wanted to give loan to the director. Okay, the company wanted to give loan to the director, and it was devised to sell land, to sell property. No, that was not the case. When the company had purchased this property right in the beginning, that time only there was an option given to the director that in future the director wants, he can purchase the property from the company after making necessary payments. And this whole transaction was not to indirectly give loan to director. It was a transaction of its own that company had sold this land as part of this agreement, even initially when the company had purchased this, and the balance was payable because of the sale of the transaction, sale of the property to the company, and it was finally decided that this is not a loan. So in short, what is not a loan, by the nature of that particular transaction, we cannot convert that transaction saying that no, Baba, it is loan.
Absolutely,
So,
you are right, actually, Anshu. In fact, I remember this case was there somewhere in 1990s, 92 or 93, I think so.
Yes, sir, 1991.
The court very categorically said what you call the intent. There is no such intent of giving a loan at all. It is nothing but a debt. So conversion of a debt into the nature of the loan is not permitted. That came out very clearly in this case. Similarly, the indirectly, that also came in the same case, I think, saying that a credit sale of the immovable property, which is totally outside the purview of Section 185, that also came out in this particular case, if I remember correctly.
Yes. So similarly, let's take in a live example that you have sold certain goods to your director. Okay. And the director has to pay towards that. Say, supposing I'm a real estate, I'm construction company, I sell flats. So if anybody buys flat from me, there are certain installments, like you have to pay 2 months after this construction, and then there are slabs as well as when as the company progresses with putting the slabs and etc., the customer has to make payments. And also a director of the company buys one of the flat from this company and pays as is any other customer required to pay, in installments, in various installments, and he is following that. Will we say that the company has given loan to that director? No. This is a sale and purchase transaction between a company. So what is not a loan cannot be converted in a loan.
See, the only thing is that one has to take precaution whenever the examples what you have given, as far as the purchasing a property is concerned. That point of time, the credit period what you have given to him, it should not be unduly long. Whatever you are going to give it to any from the public, any person from the public, it should be more or less on the same lines. No extra privilege is to be given to the director. If any extra privilege is given to the director, that may amounts to indirectly you are giving that loan. Because the words used here is directly or indirectly also. So one should be very careful about that.
Yes. So in my own example,
there is somebody has put a question. If the company has given a loan to the employee who later became a director, will it be considered a loan to a director? I said in the beginning also, it is actually law says very categorically at the time of giving loan. So at the time of giving the loan, whether he was a director or not, that is to be interpreted, number one. Number two, whatever the loan which is given earlier, if that exempted, it will continue to be exempted. Only the future loans will be getting covered. Correct?
Yeah, true. But sometimes the companies design it. You're absolutely right, Bala sir. But just a caution point here that that in a week's time you're wanting to make that person a director.
Yeah, the intention should not be there.
Yes.
See, the purpose is to defeating the law. I'll first give you a loan. Wait for a period of a week or something. I'll make you a director. That intent should not be there.
Very true. Yeah.
This is what it came out in the 1991, the Anshu Mehta's case. The intent, that is
intent should be very clear, and it should not be just you are not devising it to defeat the provision.
Yeah, that is right.
Yeah. So we discussed a prohibited category, just few illustrations to to deal little more in depth about prohibited category. As we discussed that we cannot give loan to the director of the very lending company and holding company. So this is what this diagram shows, that here is S Limited wants to give loan to D1 to D9. So D1 to D9 is nothing but the D1, D2, D3 is director of S Limited, which is lending company, but it cannot give D1, D2, D3 and also 4, 5, 6, 7, 8, 9 who are the directors of the S Limited's holding company. It will not only restrict to H1 directors, it will also go to H2 Limited holding company directors, ultimate holding company. One more example of this. A partnership companies. If the recipient is a partnership company, then the directors of the lending company in this D1 to D9 and also their relatives. Each of the relatives of D1 to D9, none of them should be the partners of this partnership firm, then only the loan can be given. Otherwise, it will be a prohibited loan. In this example, see, change the example. Now, H1 Limited wants to give loan to D1, D2, D3. Who D1, D2, D3 is what? As Sudhakar sir had clarified that there is no restriction on giving loan to the directors of the subsidiary company. And we discussed about it. And this is what it shows, that you can give loan to the direct individual who are directors of the subsidiary company. There could be one interesting point here, that suppose in D1, D2, D3 were also the directors of lending company and holding company, right? There could be possibility. So can you give that? You may say, one can argue that it also, you said that I can give loan to the directors of subsidiary company and I'm giving him in that capacity. But I said, no, I will say, no, you cannot give, because it also happens to be the director of the lending company or holding company. So that there you can't take this argument. We have discussed about prohibited category. Now we will discuss about regulated category. What I mean by regulated category is that loan can be given, but there are certain requirements, procedures, approvals required to be followed for giving of that loan. So let's discuss about it. A company may advance any loan, including any loan represented by good debt, or give guarantee or provide security in connection with loan. So again, see here, in connection with the loan taken by any person in whom director of the company is interested. So subject to the condition that what is the meaning of any person in whom director of the company is interested, we will deal subsequently just after the next slide, in the next slide. But what is the procedure? What is the approval process? What are the one or two things we need to do for giving loan to the people in whom director of the company is interested? Is like this. Firstly, you need to take approval of the shareholders by way of passing special resolution in general meeting. In the special resolution, you have to give explanatory. In the explanatory statement, you have to give full details of the loan, guarantee and security, full particulars. What is the loan amount? What is the tenure? What is the rate of interest? What is the security package for that? The complete details of the loan, or if it is guarantee security, the complete details and the terms of these loan guarantee and security needs to be provided in the explanatory statement. And what is that recipient going to use it for? That also needs to be disclosed in the explanatory statement. The recipient is going to use loan for his business purpose or whatever is the purpose. Okay. That needs to be clearly explained in the explanatory statement. If your subsidiary is taking loan from a bank and for that you are giving guarantee and security, then all that details that this guarantee is being given for the loan being taken by the subsidiary from this bank and the loan will be utilized for this purpose and so on needs to be explained clearly in the explanatory statement. The next important thing is that what Act says that the loan should be utilized by the recipient, by the borrowing company for its principal business activities. So what is principal business activity? Principal business activity is what the borrowing company is actually engaged into. In my view, having that just clause in the memorandum as one of the object clause is not okay. You need to be actually carrying on that business. Of course, if you're carrying on that business, you will have it in the part of memorandum, but you need to be actually carrying on that business to be called as principal business activity. Where is your operating revenue coming from? Supposing you are a startup company and the revenue has not yet started coming up, but where is your operating expenses going towards? So it should be going towards your business, actual business that you're trying to set up. If you're a startup company or newly incorporated company. So basically, what is your core business and whether this loan will be utilized for that core business or not. I'm just repeating, having that clause just only in memorandum and not actually doing it, and then you call it as a principal business activity. In my view, it's not okay. So just a quick recap, you can give loan to a person in whom director of the company is interested after passing special resolution, giving full disclosure in the explanatory statement, and The loan should be utilized by the borrowing company for its principal business activities. These are the conditions. For the regulated category, we discussed that this can be done for the entities in which the director of the company is interested. So what are that categories? Let's discuss about that now. The section provides an explanation for this. The expression in whom any director, any person in whom any of the director of the company is interested means following A, B, C. First is any private company of which any such director is a director or member. So first category is about private company word. Okay, so foreign subsidiary will not fall into it. The word uses private company. We know all that meaning of the word company is a company which is incorporated under the provisions of the Companies Act. So a company which is a private company in which any such director is a director or member. So in which the director is a director or member. I want to now again want your attention here on the word any such director, which I have also kept in red. While discussing the prohibited category, we discussed and said that such director means not only director of the lending company, but also of the holding company of the lending company. Here, in my view, I would also invite views of Mr. Sudhakar sir and Bala sir here, that in my view, the word such director, I am interpreting here as limiting to the director of the lending company. And I would give you a reason why here, why I'm doing that. If you see here the explanation, the word, I picked up the word right from the section, in whom any of the director of the company is interested. The section has used the clearly word, in whom any of the director of the company. The word of the company is used very clearly in this section, not only once, but twice. And hence, I am forced to take that interpretation that when section clearly is saying that director of the company, why should I go to extend the words to holding company, which is the placing and the wording of 185.1 was different. And the way it is worded in 185.2 is different. It was not the case when before 185 was amended, but the way it is now, it clearly uses the word any person in whom any of the director of the company is interested. And because the word of the company, in my view, in private company of any such director, and in which here such director, I would restrict to the lending company's director. So meaning thereby a private company in which the director of the lending company is the director or member. I will take a pause here to take views of Sudhakar sir. And
I agree with you, Anshu. I agree with you. That is the director of the lending company only. That is how it is.
100% you are right. Your interpretation is absolutely, I'm in agreement with you.
Okay.
That is the way it is.
Sure. Okay.
But one thing I want to have a thing, maybe it sounds hypothetical. Is there a way section 185 can be circumvented by using giving a loan through a partnership form? That means, a group of people, they form two private companies. These two private companies, they give the loan to the partnership form. Okay, in which these directors are actually having an interest. Because directly you are not giving the loan. So section 185 is not attracted. But here it is a partnership form you are using via media here, where these people are all interested. Can this section be circumvented?
Sir, you meant that private companies giving loan to partnership. That's what I understood.
Yeah.
There's a private company.
See, specifically, there are a group of people, they actually have a body corporate, they form specifically two private companies. These two private companies, in turn, they give the loan to the partnership firm. In that partnership firm, the group of directors are substantially interested.
But if you say they are interested, the section prohibits it, right? That a director of the company should not be partner, or even their relatives should not be partner. So if they are partners or their relatives are partner, it's clearly a prohibited category.
Okay.
Yeah. Moving on to second point number B, any body corporate. So I would need attention here. The word uses any body corporate. Unlike clause A, the words any private company was used. Here it's words body corporate, meaning thereby it's not only a private company, but also a public company or even a foreign subsidiary, right? Even a foreign company, so private company, public company, foreign subsidiaries, any body corporate. So all these three categories at a general meeting of which not less than 25% of total voting power may be exercised or control. So the directors of the lending company should not be having voting power of 25% or more in this borrowing company, the recipient company. It is not only that if the directors, one of them or maybe put together also have this 25% voting power, this entity would be considered as an entity, this body corporate, in which director of the company is interested. So point number C is about, again, a recipient company. We are talking about this ABC is about not lending company. These are the categories for recipient, the borrowing entity. So recipient entities happens to be such body corporate whose board of directors or managing director or manager is accustomed to act in accordance with the directions and instructions of the board or of any directors of the lending company. So meaning thereby, if the recipient company, that is the borrowing company's board or MD or manager, is taking instructions from the director or directors of the lending company. So we know the word accustomed to act is a very subjective term. How do you check that this borrowing company's board is accustomed to act on the instructions of the lending company or not, right? Sometimes we think that they're in a group company environment, it is quite possible that the board of the lending company and the recipient company, borrowing company, have a common board. Maybe it is fully common. Mr. A, B, and C are on the board of lending company, and the same people A, B, C are on the board of the recipient company, that is a borrowing company. Will we say that just because they are common, can we say that they are accustomed to act? The board of the recipient company is accustomed to act on the instructions of the lending company because it has exactly common board. In my view, no, there are enough, also in this case, there are enough judgments of the courts whereby it is held that you can't assume that just because they are common, they are accustomed to act. You know, we all know that directors have a fiduciary duty to the company on which they are on the board. When Mr. A, B, C are taking decisions on behalf of the lending company, they owe certain duty in that their decisions has to be taken in the interest of the lending company. Similarly, when they are taking decisions sitting as a director or the board of company B, that is lending recipient company, they need to take into account and be fiduciary responsible to the recipient company, borrowing company here. Not only this, for example, for any other business transactions, any other decisions, what they are taking in their capacity as a board of any company, they are fiduciary responsible. There is duty defined also in the Companies Act that they are fiduciary responsible as their capacity of the board. So in short, just being common between company A and B, we cannot say that they are accustomed to act, and hence it falls into this category. A few more examples that we commonly get confused here is that, say, the board of borrowing company, are the employees, the direct people who are on the board of the recipient company are the employees of the holding company. Okay, generally we see that, right? The holding company employees are made directors of the subsidiary company, or maybe the holding company directors are made also the subsidiary companies. So again, we feel that because they are employees of the holding company, can we say that no, they are supposed to take instructions as is given by the holding company? Again, no. Just being the employee of the holding company and you are director of the subsidiary, it does not mean that being on the board of subsidiary company, you are bound to take instructions of the holding company. When you are taking decisions on behalf of borrowing company, you are taking the decision as a director of that company, irrespective if you are the holding company's employees or the director of the holding company. So meaning hereby, in short, just being commonality of registers, just being direct employee of the lending company and so on does not mean that a person is accustomed to act on the instructions of the lending company. You need to, it does not even mean that you just can ignore it, this provision, and blindly says, yes, it is not accustomed to act. Each and every situation needs to be examined in detail. That is there any agreement whereby between the lending company and recipient company, whereby it is very clearly agreed between the two that this company will take instructions from the board of the lending company. Is there any resolution passed? Not necessarily agreement. Agreement could be one, or there could be a resolution passed in the board of this company which is taking loan, that board of directors for certain particular matters will take the instructions or advice of the board of this lending company. Whether the articles of this particular recipient company are modified and is there any restrictions that it cannot take any loan beyond this amount without the instructions of particular Mr. AB or the board of the lending company, or so on. What I mean that you need to examine that particular case. Is there anything on record to say that, yes, the board of this company is supposed to act on the instructions, unless and until there is something on record to prove, yes, that board of this company, lending recipient company, is taking instructions from the board of lending company, it cannot be presumed.
Some questions have been actually put to you.
Okay, sir. Yeah.
Saying the shareholders approval required under section 185. Is it prior or post, or can it be either of them both? Because it is mentioned in the section 185(2)(a) proviso. It uses the word loans given. Please explain.
In my view, it is prior, and that given is a typo, because if you try to word given, that means in every case it should have been given, right? In my view, that the proviso, the given, is a typo, and it should be a prior approval.
Yeah, always it is a prior approval. I agree with you.
Yes.
Subsection 2 covers
not only that, Bala. See, 1 minute. See, if you see the subsection 2, it starts like this: a company may advance any loan, including any loan represented by a book debt, or give a guarantee, blah blah, or provide security in connection with any loan to take any person in whom any director of the company is interested, subject to the condition that you pass a special resolution, blah blah blah, and all. That word "subject to condition that" itself means you have to have a prior approval by way of a special resolution. It is very clear. There is no absolute, and there is no ambiguity. There is no scope of any interpretation at all. It is a prior approval always.
Subsection 2 covers loan to entities which directors are interested. It does not cover loan to directors themselves. Does it mean the loan to directors is completely prohibited?
Yes, I think we already discussed in detail.
I think you gave in the beginning only what is prohibited.
Right.
Actually,
Right.
This cannot be done. Yeah.
Right.
When the director is interested in another company, whether he can participate in the board agenda for section 185, since he is not interested under section 184.
So, meaning that in the recipient company he is interested, right? That's what it means. That's what the question means.
That's what I understand by reading the question. So
if he is interested, we need to see that interest has to be, what I say, that interest should not be just fiduciary interest. It should be a peculiar interest. If yes, it is, he is interested, he cannot participate.
So a private company with the director or his relative of the holding company is a director, can loan be given?
So could you repeat your question? I didn't get you fully.
A private company in which a director or his relative of the holding company is a director, can loan be given?
I'll just go to the chat because I'm not able to get it.
That, 1 minute. See, every time I say this thing, that the request to the participants to get the concept clarity, than of asking the permutation and combinations. You can ask any type of permutation combination questions. You might be facing a particular problem. That doesn't mean that you get it clarified on the webinars. What the purpose of these webinars is to get the clarity, what you can do, what you can't do. If you can do something subject to the conditions, what are those conditions? So please get the clarity of the things, not like that you are giving a scenario and asking the panelist, to give you the answer for that. There, what will happen is sometimes, as again, I repeatedly say that last 2-3 webinars also I mentioned this. You are putting some question, a particular problem you are giving to the panelist, and you are thinking that you have given the full information, which you might not be giving, and you are expecting that the panelist understood that whatever you have given the information, which may not be so. So the answers may go wrong. I'm cautioning you time and again, please don't do that. You first of all, you get that section, what are the provisions, that you get the clarity. Otherwise, you can ask n number of questions. My wife is giving a loan, my son is giving a loan, my uncle has been given a loan. Is my uncle my relative or not? These questions are, according to me, not, proper questions. But now what happened, because of this small issue, now she has to go back to the slides, try to understand the question and give some answer, which may or may not be correct. Because that depends upon the understanding. So Bala, my request to you is let us ignore these kind of questions. We should not take up enough. I'm very firm in my view as far as this is concerned.
Then the next question also more or less that way only, because saying that, I passed a special resolution under 185(2) and my subsidiary company director have to 10 crore amount. The amount got exhausted in 2022. Suddenly the subsidiary repaid the loan. So can the company be again give the loan? It is again same nature.
I'm telling you, see, these are again the same thing. You can put any number of permutation combination questions. So if at all we have time at the end of the day, you take up these questions. Otherwise, what happens is, as far as the section is concerned, no doubt about it, there are certain, you require that section, whether the prior approval is required or not. Yes, I appreciate that point, that kind of questions. Then we can give an answer also by yes, prior approval is required and what is the rationale for that. Somebody said that that means you mean to say giving loan to a director is completely prohibited. Answer is yes. You can give the rationale for that. These kind of personal questions, giving a particular question with a particular scenario, that is not correct.
Okay. Loan given to an associate company for VRS payment can be treated as a principal business activities.
So in my view, VRS is not a business which the company is actually engaged in. It should be used for the business of the company.
Correct.
Yeah, it is not a what you call principal business, but as you rightly said, in connection with the business, if this purpose, again, as you rightly say, the purpose for which it is given, what is the scheme, what is the arrangement, etc., and other thing and all, that detail we'll have to go into the see, and then we'll have to see whether it is in connection with the business or not in connection with the business. I think that has to be applied here. Yeah.
Right. Should we move on, sir?
Yeah, you can move on.
So a very quick discussion on, as we I think already discussed, there should be clear and usual practice of direction and instructions to say that it is a custom to act or not. It's a question of fact and not a question of presumption. In various court judgments, it has been held that we just cannot lift the corporate will of the subsidiary and say the board of directors of subsidiary are accustomed to act on the instructions of holding company, and it needs to be examined thoroughly in case-to-case basis. And the last, as you can see on my slide, is section 259.
Anshu, just 1 minute, I will take that. As far as accustomed to act as per the instructions, this in the previous webinars when we were discussing about related party transaction, in subsection 276 also, section 2 subsection 76 also, when you are defining the related party, there also it comes that accustomed to act as per the instructions of somebody, that somebody will become a related party to you. There we have extensively discussed that when somebody is alleging that you are accustomed to act as per the instructions of somebody else, the onus of proof is the person who is making that allegation, number one. Number two, when you say that you are accustomed to act as per the instruction, there should not be a one-off transaction. If any one-off transaction is there, then you cannot say you are accustomed to act as per the instructions of somebody. Number three, also that you cannot, that the wholly owned subsidiary company is accustomed to act as per the instructions of the holding company. That presumption is also not valid, because every company has a corporate personality. The board of directors of the wholly owned subsidiary, they have their own responsibilities and accountabilities legally to discharge that. That's why you cannot say that wholly owned subsidiary is accustomed to act as per the instructions of the holding company of that. Okay. So this we have discussed already. So the same logic, same rationale we can apply here also. In case anyone wants further clarity, you may refer to the previous webinars on RPT. You will find that this thing. If I am not wrong, that is the second webinar or first webinar, I don't remember exactly, where we discussed about the definition of related party.
Yes, sir. Rightly, 259, 260 bracket definition of officer and default, related party. All these sections have also used the same term. So few examples of regulated category. I'll move a little fast because I think we are facing now short of time. So subsidiary company in this example is giving loan to XYZ Private Limited. So as you can see, if XYZ Private Limited, the loan can be given provided that none of the directors, so D1, D2, D3 of the lending company are director or member of XYZ Private Limited. If D4, D5, D6 or D7, D8, 9 are directors or member, the loan can be given. We have discussed the reason why. In this example, D1, D2, D3 are the directors of S Limited. XYZ Limited, if wants to get loan needs to be given to XYZ Limited. Even if D1, D2, D3 are on the board or member of XYZ Limited, we can give loan, but we need to pass the special resolution. This is an example of a custom to act. Again, same thing. If it is proven that yes, the board or MD or director of XYZ Limited is accustomed to act on the instructions of D1, D2, D3, still the loan can be given with special resolution and so on. So we have discussed prohibited category. Prohibited category was all directors, individuals, firm. Permitted regulated category was private company, body corporates of two types. And the third now we will deal is the exempted category. That is permissible category. So first example.
There is one question has come. Can a blanket approval of the shareholder be taken under section 185(2) up to a certain limit in the beginning of the year itself? This would be for all 185 loans by a company in a particular financial year.
So in my view, this is not a good practice and this is not the spirit of law. As we saw that what it says is that in the explanatory statement to the special resolution, you need to give details of the loan. The purpose I feel of the special resolution is the shareholder should be given the opportunity to examine that particular transaction. If you are taking a blanket approval, then I think it is not the intent of law and not the spirit of law. If the shareholders have passed and nobody, see, till the time nobody is objecting, you keep on doing such things. But we should ask ourselves that, can that be the intent of law? I think the answer is no.
No, in fact, as you rightly say, there is a detailed explanatory note which is required to be given whenever you call for the general meeting. What is the purpose? Explain the purpose. What is the rationale behind it? All the details call for the detailed disclosure whenever you call for the general meeting.
Right.
Then only you can put for voting to the shareholders' interest. So in view of that, what you say is absolutely correct.
Yeah.
Can a loan given to the subsidiary for the repayment of the loan taken by the subsidiary for its business qualify as a loan given for principal business?
So, sorry, what it mean that if I am taking this loan to repaying the earlier loan, did it mean that the question?
That is what it appears to be.
Okay.
Because can a loan given to the subsidiary for repayment of the loan taken by the subsidiary for its business qualify loan given for principal business?
So I feel yes, in this case it can be given, because if you are seeing refinancing the loan and it is just at better commercial terms for the company and you are using it, that in my view it should be okay.
That's all I
now
think.
we have to speed up because it is already 12 o'clock. We have
Right.
1 more hour only.
Yeah.
So
Yeah.
186
Yeah.
is a very long section.
Yeah.
Right,
so
sir.
only
Yeah.
touch that important points in 185 as well as in 186 also. Then you
Sure.
can, I think, Bala, that we can take the questions maybe after a particular period, maybe after half an hour or so, something like that.
Sure.
Yeah.
Right. So quickly, exempted only loan to MD and WTD. So only loan to MD and WTD as part of conditions of service is exempted, or if it is loan is given pursuant to a scheme approved by the special resolution. I will just want to clarify here that what is exempted is only and only loan. Supposing the MD of your company is taking a home loan from, say, HDFC Bank, for example, and he wants the company to give guarantee for that loan, which he is taking from HDFC. Is that allowed? The answer is clearly no. What is allowed is the company is giving loan to managing director or whole-time director. But if the company is giving any kind of guarantee or security for the loan being taken by MD or WTD, that is not allowed. And so what is allowed is just that loan, and either there are two options. Either there should be a loan prevalent company, that company gives loans to certain employees and cadre of employees depending upon their grade and designation, or if there is no such scheme in the company, that company has framed a special scheme for giving loan to MD and WTD, which is approved by shareholders. Moving on to that company, NBFC, housing finance company or banking company can give loan in their ordinary course of business, and provided they are charging interest for that particular loan. You know, sometimes some company secretaries take a view here that even my company, say supposing I'm a manufacturing company, and so if I have excess money, I can give loan to my subsidiary, and that's also an ordinary course of business of the company, which according to me is not okay. This particular exemption is for the companies whose business is to give loan and etc. And of course, if their business, they will charge an appropriate rate of interest for that loan. So this is one exemption of ordinary course of business.
So that is what you are talking about, the people who are actually doing a business are actually financing companies.
Right, sir. A normal company, a manufacturing company or trading company, whose business is not to give loan, cannot take this exemption, is what I meant.
Yeah, you are absolutely right. In fact, what you said, I experienced this about 35 years back. When the managing director who was there in our company, he actually wanted the housing loan. But the company had its own scheme of the housing loan to provide to all the people in general. But in spite of that, the board wanted to be very cautious, since we are giving a loan to managing director, since he is being a director, whether we will have to take a permission, approval, etc. It was elaborately discussed. As you rightly said, if the company has got a common scheme which is applicable to everybody, by virtue of the managing director being an employee of the company, it automatically approves for him also, because company has formulated the scheme for that. That is what it was said. It happened about 30 years back. Today you are saying that. I remember this. Yeah.
Okay. The third exemption is about giving loan or guarantee or security by the holding company for its wholly owned subsidiary. So here, in case of wholly owned subsidiary, all three is exempted. By meaning all three, I mean is that loan, guarantee, as well as security. But when we come to, if your subsidiary is not wholly owned subsidiary, then what is exempted is only guarantee and security, meaning that loan is not exempted. So if it is WOS, all three is exempted: loan, guarantee, and security. If it is other than WOS, only guarantee and security is exempted. If it is being taken, there is also a condition that if it is being taken in case of non-WOS, if that loan is being taken from the bank or financial institutions. And there is one more condition, that in both these cases, wholly owned or non-WOS, the loan should be utilized for its principal business activities, which we even discussed before. If it is not going to be utilized for this subsidiary for principal business activities, then exemption is not available. Okay. We have discussed all the three categories. Quickly, in next 5 minutes, we will discuss a few important points out of 185. As we discussed the three categories, in the first category, prohibited, we discussed that it was limited to directors, holding company directors, or the firm, or their relatives or partners. Okay. Second category was about regulated category, in which there is restriction on private company or body corporates. Right. The third was about exemption to MD, to ordinary companies which in this ordinary course of business, or WOS or non-WOS. But we saw that nowhere there was a mention of trust. Nowhere there was mention of LLP. So let's briefly discuss whether the loan to trust, where directors of the company are interested, can be given, because it does not talk about it. Section does not talk about it. So in my view, as we clarified, that what I understand, the intent of the section is that director who are taking decisions on behalf of the company should not be abusing their position, should not be taking decisions which favors themselves, right, at the cost of the company. So if you're giving loan from a company to a trust where the directors are privately, like it's a private trust and the directors of the company have interest in that trust, it is made, say, family trust or something, then it should not be given. But let's assume that trust is the charitable trust for the benefit of the public at large, and the director per se is not going to get any benefit out of that loan. Then in my view, it could be given. Similarly, loan to LLP. Nowhere section talks about LLP, and so what should be taken? We should consider LLP as a firm, we should consider LLP as a body corporate, and whether the loan to LLP can be given or not. And especially the LLP is that where the directors are, say, partners, or the relatives of the directors are partners. If it is that LLP, in my view, again, you should go behind the intent of the section. And if it was a firm, if it is a firm and where the directors are getting benefit out of that loan because they are partners of that LLP, or their relatives are partners of LLP, again, we should not, it cannot be given, or it can be given only with special resolution. But again, I think we should take a view here that LLP is a firm, same like the MCA has clarified in the SBO rules, and it should be not given even after passing of special resolution, taking the view that LLP is a firm in this scenario. We discussed about guarantee in security is not okay. Loan to manager. All throughout, we have been talking about directors or the people in whom directors are interested. What about manager? Right? Section is totally silent about manager. You know why? Because manager may not be a director, right? If it is a director, he'll become MD and it will not be a manager. So loan to manager, he is not on the board. So it is not restricted at all. It can be given. And a manager is just like any other employee of the company, right? Of course, he has substantial powers, but he is also an employee of the company, and loan to manager is allowed. Loan to subsidiary company, which is a non-wholly owned subsidiary. So while discussing about exemptions, what we discuss is that loan to wholly owned subsidiary is exempted. And in case of non-wholly owned subsidiary, what we discuss is that only guarantee and security is exempted. So my question is whether company can give loan to a subsidiary, which is not a wholly owned subsidiary. So again, clarifying here, we always get confused. Okay, that the section does not give any exemption for loan to subsidiary, which is not WS, and we cannot give loan, but that is not the case, right? You need to examine whether your subsidiary is such a subsidiary which is falling into the definition of an entity or person in whom the directors of the company are interested. So basically regulated category. If your subsidiary is one such company, that is a private company, director of the company is director or member, or director is having 25% voting power or custom to act and so on, the regulated category, then you can give loan to that subsidiary with special resolution. Otherwise, if it is such a company that subsidiary is not falling into regulated, then where is the restriction? You can give loan. Lastly, loan from subsidiary to holding. We always discuss about exemption from holding to subsidiary. And there's a question, we always think that whether subsidiary can give loan to holding company. Again, here, I would say you need to examine the regulated category. If your holding company is falling into the regulated category, of course, you can give loan with special resolution. If it is not a company which is falling into regulated category, there is no restriction per se in the act and the loan can be given. With this, I conclude section 185. I think in the interest of time, we can exclude fines and penalties and etc. under 185. Briefly, you all know that there is an exemption notification for private companies under section 185. And these are the three conditions. That is, in that private company, no body corporate should be a member. It should not have taken any loan which is more than twice of its paid up capital of 50 crore, whichever is lower, and there should be no default. If all these three conditions are in compliance, then the private company is exempted from 185. That means it does not have to comply with section 185 and the loans can be given. So I'm not discussing about Nidhi and government company because that's not largely it is in no. So in the interest of time, I would like to skip audit points because I think more or less all of them we have already discussed while discussing section 185 in detail. Moving on to quickly section 179. Powers to be exercised at a board meeting. I always get some questions. Who is the authorized signatory of the company? Give me the list of authorized signatory. Give me the name of authorized signatory. I get this kind of request from business teams. Ma'am, please give me the list of authorized signatories. I said authorized signatory for what? For what purpose? For what matter? If you give me the matter, I will go and check whether there is any authority given for this matter. So what, whether a individual person, the individual director, who just being by virtue of the director gets the power to take decisions on behalf of the company, Whether a managing director, just by being a managing director, gets authority to take all the decisions for the company. I'm again repeating, just say, supposing I'm a director of a company, can I take decisions on behalf of the company without being discussed at the board meeting? The answer is no. An individual director, without being authorized by the board, does not have any powers, just being by virtue of director. There is no concept of just authorized secretary of the directors, that just because I'm a director of the company, I can take decisions and I'm authorized to take decisions on behalf of the company. All the decisions have to be taken by the board as a collective body of the board, right? And in view of that, there are certain powers which Companies Act prescribes that should be taken by the board only at the board meeting, meaning thereby that they cannot be done by virtue of circular resolution. So few of such powers that we'll just quickly discuss is that right to make calls on shareholders for unpaid shares, unpaid money on their shares, buyback. C is to issue securities, including debentures. To issue securities, just to clarify here, that board needs to approve the issue of securities. Once the board has approved the issue, then the allotment, which is post-issue of securities, can be done by the committee or the person who is authorized by the board. But issue of securities, board cannot delegate. It has to be discussed by the board at the meeting. To borrow monies. So authority to borrow monies has to be discussed by the board at the meeting. If here in this to borrow money can be delegated, we'll discuss in detail thereafter to whom it can be delegated, but to borrow money has to be discussed by the board at the meeting. Similarly, is to invest the funds of the company, to grant loans or give guarantee and security. Again, here the words are in respect of the loans. So in 185, in 179, and also when we discuss 186, mind you, the words used in connection with guarantee and security is in connection with the loan. So DEF, that is to borrow money, to invest funds of the company, and to give loan and guarantee, provide security. In all these three scenarios, delegation is possible. The board can delegate these powers to a committee or to managing director, but the delegation should not be blanket, saying that you can borrow any amount for behalf of the company. The delegation has to be with checks and balances. You have to give certain, if the board wants to put certain restrictions that you can invest in only these kind of securities, only up to this much amount, those amount caps and etc. has to be built in the resolution. Then only the delegation in these cases, only in these three cases in section 179, it is possible. Right? To approve financial statement and board's report, we know. To diversify the business of the company, many times we forget this. If you are passing any board resolution which is in connection with which tantamount to diversification of the business of the company, then it needs to be passed at the board meeting and also needs to be filed with the MCA. To approve amalgamation, merger, reconstruction, to take over or controlling, acquiring substantial stake, all these again needs to be discussed only at the board meeting. To make political contributions, appoint, remove KMP, internal and sectoral auditors. I think this is all standard. We know it. This also section says ki it is not that because section provides the board can discuss, the shareholders cannot impose any restrictions. If the shareholders of the company want to impose certain restrictions on these powers of the board, they can very well do it. And we discussed about that few powers can be delegated, and they can be delegated to subcommittee of the board, managing director, manager, or principal officer of the company. But yes, while you are delegating, there can't be a blanket delegation. It has to be coupled with you have to provide maximum amount. And if there are any other checks and balances, which while at the time of delegation, board wants to add, it can definitely add. I just wanted to touch upon 179 in the interest of time. You all have Sudhakar sir or Mr. Bala sir, you want to add anything on this 179?
No, you can go ahead.
Sir, you are on mute, Sudhakar sir.
Yeah. Only one thing I want to add is that when you delegate the powers after deciding by the board, when you delegate the power to a subcommittee, that subcommittee can pass the resolutions by circulation. There is no need to have a meeting of that particular committee. They don't need to meet and pass the resolution. That resolution can be passed by circulation.
Yeah. Here, just one point, since you mentioned this, I recall, sir, many times there is a confusion that this particular board resolution of which says delegating the authority to borrow, this has been passed and filed with the MCA. Okay. And whether the subcommittee resolution needs to be filed is, I think, many times.
They are not required. They are not required. only the umbrella resolution what the board is passing, that is to be filed with the with the ROC. And as you rightly said, when you delegate it, and the delegation also, the terms of delegation to be clearly spelled out. When you are delegated, you can delegate it to a committee of directors, you can delegate it to a managing director or manager, or sometimes even to a CFO also. But the delegation should be clear enough so that the person to whom you have delegated the power, he can exercise that powers as per the delegation only. He will not exceed his powers.
Yeah. So just 2 points, as Sudhakar said, at committee level, it can be circular, it can be meeting, and these resolutions, if you are filing, there's nothing wrong, but not required to be filed. But if you say, okay, I will not pass the board resolution, which was delegating it, MGT 14, and I will file it for each and every tranche at the committee level, that will be wrong. You need to necessarily file the delegation resolution, even if you're filing the committee resolutions. Okay, so to begin with section 186, which talks about layering. Okay, to explain you 186 in which talks about investment layers, I will also have to briefly touch upon the layering rules under section 287 that deals with subsidiary, because without which I will not be able to explain fully. So to begin with it, section 186 subsection 1. It principally says that companies not to have more than 2 layers of investment subsidiary, right? So we know under 287 in the definition of subsidiary also there is a layering rules. What it says is that a company is allowed to have 2 layers of subsidiary, and along with 2 layers, it can have 1 layer of subsidiary of wholly owned subsidiary, and which this wholly owned subsidiary is not considered as a layer. So 1 wholly owned subsidiary, and in addition, 2 additional subsidiaries as a layering rule, what is allowed under subsidiary definition, right? So altogether 3 subsidiaries allowed, 1 WOS and 2 additional subsidiaries are counted as layer. But 186 adds to it. Okay, just don't get confused that if I'm complying with layering rules under subsidiaries, then what 186 is, 186 additional layering rules, they both needs to be complied. That layering rule is in general, and 186 rule is in particular talking about investment layering. What is an investment company? Do you all know that investment company is defined as an explanation to subsection 186? Quite often we get confused with the investment company as an NBFC company. You know, we know that classic rule of deemed NBFC of twin test of 50 and 50. So twin test of company which is meeting the twin test of 50% is a deemed NBFC. But is that company an investment company? The answer is no. That's a different definition under RBI Act, and investment company is separately defined under explanation to section 186. So I'll just I think I have in subsequent slide what is actually meaning of the investment company. So let me just cover here briefly. There are 2 exemptions to section 186. The thumb rule is that you cannot have more than 2 layers of investment company. There are 2 exemptions to it. While acquiring a foreign company which has more than 2 layers of investment subsidiary, even if it has more than 2 layers of investment subsidiary as per the laws of foreign country, you are still allowed to acquire it. And if you are required to have more than 2 layers of investment subsidiary because of, say, Income Tax Act, or because of, say, banking regulations or IRDA regulations in particular, because you are governed by some special act and the requirement of that special act requires you to do some restructuring, and then only you are allowed. But this cannot be used for your otherwise. Sorry, I use the word income tax. That is not allowed. It's only allowed for banking or IRDA, some special regulations. So there are only 2 exemptions on 186(1), and you also have to comply with layering rules under 287. So in this example, I have shown that company A Limited has 3 subsidiaries: B Limited, C Limited, D Limited. So this is a perfectly okay structure. This is perfectly allowed structure. There is no restriction on horizontal layering. A Limited can have even 100 subsidiaries below it. There is no restriction. What is restriction is on the vertical layering. So in this example, say H Limited has S1 Limited, S2 Limited below S1 and S3 below S2, right? So S1 Limited, although it has 3 subsidiaries, but S1 is a wholly owned subsidiary, which I said is perfectly allowed and okay. So this layer is also in compliance with the layering rules. Now, see this example. In this example, H Limited has first investment subsidiary I1, below I1, I2, and below I2, I3. The only difference between this slide and the next slide is that in this slide, I1, I2, and I3, I means investment company. All 3 are investment company. Even if I1 is a WOS, let's assume that I1 is WOS. So as per layering rules, there are two layers. One layer of wholly owned subsidiary is exempt. So there should be allowed structure, but no. Since these all 3 are investment company and as per 186 investment layering rules, only 2 layers of investment companies are allowed. I3 is not a compliant structure. I cannot have I3. I need to restrict my structure to only I1 and I2. Then only I will be in compliance with the layering rules as per, because these are investment companies. Okay. So I mentioned to you that one investment company is defined under 186, and let's look at the definition of investment company as per Companies Act. I'm just repeating here, investment company is not same as NBFC. Your NBFC may be falling also into the definition of investment company, but it may not be. You need to examine it separately. So expression investment company is defined that a company whose principal business is acquisition of shares, debentures, or other securities. I'm repeating, whose business is acquisition of shares, debentures, or any other security. See here, loan is not included. While you are checking NBFC, whether your investment is more than 50% investment is into financial asset, you also consider loans into the financial asset. Where in the definition of investment company, loans are not included. It's all about investment in securities. And it says that, firstly it says whose means a company whose business is. And then it says it will be deemed that company is principally engaged in the business of acquisition of securities if his assets in the form of investment in shares, debentures, etc. is not less than 50% of its total assets. So let's assume your total asset size is 100 and your investment into shares, debentures, or other such security is 51 rupees. Just to explain it very simplistically, even if your memorandum does not has investment into securities as your main object, but the fact is that your investment out of your total investment of 100 rupees, total asset of 100 rupees, your investment into shares and etc. is more than 50 rupees. Then you are an investment company, right? Or if it's, or there is a second clause, or your income from such investment business is more than 50% of your gross income. So an important point here, firstly, it is not same as NBFC because there is a twin test of for determining deemed NBFC, both the conditions should be met of asset as well as income. But here it is or. If you meet any of the condition, either on the asset side or the income side, then you become an investment company for the purpose of Companies Act, particularly 186 subsection 1, that you are an investment company. And if you become an investment company, what happens? If you are a company, then you more than 2 layers of investment company is not allowed, even if it is a WOS, which is allowed under layering rules as per subsidiary definition. So just to summarize, as per subsidiary rules, 2 layers of subsidiary with 1 layer of WOS is allowed. But assumingly all 3 are investment company in this layer, then it will not be a allowed structure because for investment company, you need to restrict to 2 layers. We also discussed the meaning of investment company as is defined in the Companies Act by way of explanation. That is your investment in shares, debentures, etc., or your income in from investment securities and etc. is more than 50%. And it is or. Even if you're meeting one of the condition on the asset side or income side, you become an investment company. Okay. So because I said it keeps on changing, right? In 1 year, you are an investment company. So you examine you're becoming an investment company by virtue of March 23 financials. But your investment or your assets etc. may change during the year. In the next year, you have not received dividend or interest, etc. from your investments, right? So you may not become an investment company next year. So what I mean is that investment company is the possibility that you may become an investment company for one financial year and you may not be so for the very next year. So you need to examine it every year. And these layering rules are, as per 287, are not applicable to certain types of companies, that is banking company, NBFC company, insurance company, and government companies. And very importantly, that this is a prospective provision. It is not a retrospective. So meaning thereby, if you, before the section became applicable, if you had certain layers, which was beyond this permitted structure, you are still allowed to have these layers because you had, it is not a retrospective provision. But if by virtue of some restructuring, you have reduced those layers, say you had 4 layers of subsidiary, by virtue of some restructuring or disinvestment, you have come down to 2 layers. Now you again can't go back to 4 layers, meaning thereby I was always allowed 4 layers before the before this rule came into, I was having 4 layers, I can go back to 4 layers. That is not allowed. Once you have reduced to your layer, then you need to be within the permitted layer only. Okay. So we discussed that what is exempted is having subsidiaries outside India if you're acquiring those companies. And I think that's it about investment company. I'm just skipping few slides in the interest of time. And the word investment company is also used. I hear this. We discuss apart from 186.1, what is the implication of being an investment company under other provisions of the Companies Act. That just quick discussion on that. One is about investment company not having more than 2 layers. If you are an investment company, when we discuss 186.2, we will see that there are also certain implications of being an investment company under 186.2. Also, if you're an investment company, there are certain different criteria while calculating 198 profit for CSR as well as MR. When you calculate 198 profit for an investment company, the treatment is a bit different. And there is also a different provision under buyback. And when the statutory auditors give report under CARO, there also, if you're an investment company, the reporting requirements are a bit different. And so is while calculating effective capital under Schedule 5. There also, if you're calculating effective capital for an investment company, the treatment is a bit different. I'm not getting into the nitty-gritties of each and every provision here, but that was just a quick alert on being an investment company. Before we move to 186, any comments from panelists? They want to add anything?
No, nothing from my side, Anshu.
Okay, sure.
Yeah,
okay.
You can move forward.
Okay, sir. Thank you. 186.1 was all about layering, and now we will discuss about 186.2, which deals about intercorporate loans, investments, guarantee, and security. Again, it's about giving the loan. When your company is making investment or giving loan, guarantee, or security, that company needs to examine 186. The company who is taking this needs to examine 181, A and C, etc., but not 186. Okay. Sorry, I missed that while discussing layering rules, this slide talks about that as per revised Schedule 3, there are also some disclosure requirements that if your layers are beyond permitted layers, then you need to disclose about those subsidiaries in your financial statements. Okay. So coming back to 186, it says that no company shall directly and indirectly give loan to any person or body corporate. Word here is person or body corporate. So it is not only about body corporate. If you're giving to an individual or any other entity, any form of entity or person, trust, etc., that also gets covered under 186. So loan, guarantee, security also again to any person or body corporate. Again here highlighted the word in connection with the loan. That guarantee and security also again needs to be in connection with the loan. Acquire by way of subscription, purchase otherwise the securities of body corporate. So 186 is about giving loan, here giving loan, making investment, guarantee and security. To whom? If it is investment, of course, it has to be a body corporate. But if it is about giving loan, guarantee or security, it could be person or even a body corporate. So what are the limits? If any of these 4 things put together are exceeding 60% of paid up capital, free reserves or securities premium, or 100% of free reserves and securities premium, whichever is more. So how to calculate this? So you should put your paid up, firstly, you should check what is the paid up capital. And what you will check, if supposing you are giving loan today, you will check paid up capital as on what date? Today or the March? Say right now we are sitting on 29th of April 2023. I will check paid up capital as on today when I'm giving the loan, or will I check it as on 31st March 2023? Nothing is defined in the act, nothing is mentioned in the act or in the rules. In my view, you should take the latest paid up capital. Similarly, securities premium, latest securities premium as on date should be ticket. And this is paid up capital securities premium. It is not something that, no, it will keep changing with audited numbers, right? It will remain same. Whereas free reserves, you, even if you want, you cannot take the latest as on date free reserve, because free reserves is a defined term under the Companies Act. Okay, under section 2, subsection 43, it is defined free reserves as per, which is available for dividend and as per the last audited balance sheet. So free reserves compulsorily has to be taken as on 31st March 2023. So you have to calculate first these 3 figures, that is paid up capital, free reserves and securities premium, and then make this calculation of 60% and 100% and find out whichever is more. One important point here is that 186, if you're giving loan to your employees, then 186 does not apply. There was earlier a MCA circular, and now it has also been included in the section also that it does not apply to employees of the company. But one alert point here is that while 186 is exempting loans to employees, but there is no such exemption under section 179. So even if it is you are passing some resolution for giving loan to employees, you can't forget section 179, because there is no such exemption unless you have delegated it to a committee or so on. Okay, I told you that free reserve is defined in the section, in the definition section, and as you have to take it compulsory as per last audited balance sheet. Okay, so we discussed that what are the approval requirements under section 186 subsection 2. So supposing my company wants to give loan, so firstly we all know that we need to take board approval apart from section 179, also under section 186. Then we also need to take shareholders approval, but not in all situations. If I'm exceeding certain thresholds, then the shareholders resolution comes into picture. Then it clearly says that it needs to be a prior shareholders resolution, and then shareholders resolution, there are certain exemptions that certain companies does not need shareholders approval when. If I am giving loan to my WOS or to a joint venture company, so in case I'm giving loan to my WOS or JV company, that is loan guarantee and security, then the approval of shareholders is not required. Similarly, if I'm making investment in my WOS, then also shareholders approval is not required. While making investment, the exemption of JV, which was there in the loan and guarantee, is not available. In case of investment, exemption is only for WOS. So the question arises, as I said, that if I'm giving loan to my WOS or JV or making investment in WOS, I said shareholders approval is not required. But the question arises is that once I have made this investment, say I have made investment of 100 crore in one of my subsidiary. After making this investment, whether this 100 crore should be added in the limit of already given loan or not. Supposing very next day I want to give loan to a third party. So in the earlier day when I gave loan of 100 crore, should it be added in the limit of already given loans, etc. or not? The answer is yes, because the exemption given in the section is only and only for that particular investment. Once you have made that investment, it needs to be added to the limit of already made investments. And might, many times we get confused that this is exemption. The exemption is only from shareholders approval. You need to take board approval. You need to Even if it is loan to a subsidiary, you need to charge rate of interest. You need to make entry of these transactions in your register of MBP2. So just in short, this exemption is only and only from the seeking shareholders approval, and rest of the provisions of section 186(2) and 3A, etc. are applicable for even if it is to JV or WS. Then 186 says that no investment shall be made unless it is passed with the consent of all the directors present at the meeting. So supposing my board is of 10 directors. Does it mean that all 10 directors need to be present at the meeting? No. What it means is that supposing out of 10, 7 directors are present at the meeting, then all 7 directors, you need to approve that transaction. If out of 7, 1 director does not agree, then it cannot sail through. All the directors who are present at the meeting need to approve that resolution. Then there is a concept of PFI's approvals. PFI approval is required only if you have a subsisting loan from PFI. PFI is again defined term in the Companies Act. So if there is a PFI loan subsisting in your company, and if you want to give loan, make investment, etc., you need to check 2 things: whether this loan which you would be giving is exceeding the limit under 186(2) of 60% and 100%. Supposing it is exceeding, then you need to go to PFI and obtain their consent. Let's assume that the limit is not exceeding, but there is a default in repayment to the loan. There is a default that you have not paid your loan and interest to PFI. Then also you need to take PFI approval. So PFI approval is required in 2 cases. Either your limits are beyond 60 or 100, but there is no default. Even if there is no default, but your limits are exceeding. Or if there is limits are not exceeding, but there is a default. If any of these conditions are being met, then you need to go to PFI and take the prior approval before going ahead with the transaction. So one important thing about 186(7) is that rate of interest. 186(7) is the only charging section which talks about the rate of interest apart from 185 for ordinary course for business. But otherwise, for all other companies, 186(7) is the charging section which clarifies that rate of interest needs to be necessarily charged or in respect of every loan being given by a company. And which says that the rate of interest cannot be below the GSEC rate. GSEC rate means the rate that you get, the interest that you get, the returns that you get when you make investments in the government securities. So you need to examine whatever is the tenure of your loan, for what period you are going to give loan. If it is for 3 years, you need to compare that loan rate of interest with returns that you will get on GSEC securities if you make investment for 3 years. You cannot give loan below GSEC rate. It can be more. There is no condition that how much it can be. It can be as is commercially agreed. The only requirement is that it cannot be below GSEC rate. And you cannot see that GSEC rate, I'm giving loan for 5 years, but I am benchmarking it with one investment returns on 1 year GSEC securities. It should be corresponding to the tenure of loan, what you will get returns on corresponding GSEC securities investment. There is another provision that there should be no default in repayment of deposit or interest. If there is a default, you cannot make such an investment, give loan guarantee, etc. Next about register, that is MBP2. We all know that we are required to maintain the register in the form of MBP2. There is a format prescribed for MBP2. And there was a clarification that you need not make this register right from inception. MBP2 is required to be maintained right from when this provision came in, that is 1st April 2023. I will just like to take 2 minutes here that many times you have said that companies are maintaining this MBP2 in the form of Excel in the computer, right? So they keep making entries in the system, maybe once in a month, and then suddenly take a print, or maybe once in a year, if there's not much volume, make this entry in the Excel and take printout, say monthly or yearly and so on, right? Which is absolutely not okay in my view, because there's a clear requirement of maintaining these entries within 7 days of the transaction. if you are making all the monthly or yearly entries and taking one printout and authenticating it, it is clearly you are leaving the evidence that you have not made the entry and not authenticated it within 7 days. So what exactly needs to be done for proper compliance of this is that the entries for all 7 days needs to be made, and then you need to, after making entries for the 7 days, you need to take one printout and authenticate it and file it if you're maintaining it in Excel. But so you fix one day, for example, that every Monday I will make entries for the last week and then take a print and authenticate it. You fix one day, but you making entries for all 1 month or 1 year or maybe whatever period you are following, and then taking one printout and authenticating it is absolutely not okay. Okay. We discussed broadly what are the requirements on 186.2. Before moving to exemptions, I'll just take a quick recap of that. So I said there is a clear requirement of board approval, unanimous consent of board approval, of course, at the meeting. We need to take shareholders approval. When we need to take shareholders approval is 60% and 100% of paid up capital freeze and securities premium, whichever is more, 60 and 100% limit. Then we said that there is an exemption in case of WS and JV for taking approval of shareholders. Supposing you want to make 2 loan transactions, one to a third party and one to your subsidiary. Then what you can do is that firstly you give loan to third party, because then you will be probably within the limit if you're not breaching the limits. And because when you're giving loan to a subsidiary, anyways, you are exempted from those limits. But if you give loan to a subsidiary and you have exceeded the limit, then you will not be left with the balance and you'll have to go to take shareholders approval for giving that third party loan. So shareholders approval we talked about. We talked about rate of interest. It cannot be below G-Sec rate. Third requirement. Fourth is you should not be in default of prepayment of deposit or interest. Fifth is about maintaining of registers in form of MPT2. And then now let's talk about the exemptions from 186.2. So it says nothing contained in this section, meaning thereby 186.2, 3 and etc. One is about layering. So what are the exemptions? To which entities these exemptions are applicable? So it says about loan, guarantee and security investment if it is being made by banking company or insurance company or housing finance company. Even there the word used is in their ordinary course of business. So banking, insurance company, housing finance company, is they are giving the loan, guarantee and security, etc. or investment in their ordinary course of business, then they are exempted from all the requirements of 186.2, 3, 4 and etc. That is, they do not have to comply with any of the sections of board approval, shareholders approval, rate of interest, entry and so on. Also, it extends that a company which is established with the object of engage in the business of financing industrial enterprise or providing infrastructural facilities. Infrastructure facilities is defined. There is a schedule clearly given that which companies will fall into the definition, and to them it is clearly fully whole of the section 186, 2, 3, 4 and etc. is exempted. And so is for companies which are engaged in the business of financing industrial enterprise. Because here the word used is financial enterprise, it was leading to a confusion that if an NBFC necessarily has to give loan to an entity, because the word used is financing industrial enterprise. If a NBFC is engaged into retail financing, microfinancing, and it wants to give loan to an individual, whether that is allowed or not because of the uses of the word industrial enterprise. And then the MC came out with the rules clarifying that the meaning of financing industrial enterprise is not only entities, but even to any other person is also covered under meaning of financing industrial enterprise. That was covered in the rule subsequently. So these are the exemptions under 18661. There are certain more exemptions, that is to any investment. Here the opening words to any investment is very important here. So to any investment made by an investment company. We already discussed in detail that there's a definition of investment company under 186, and this exemption here is available only to such investment company which is fulfilling this definition of investment company. You cannot avail this exemption from your NBFC which is not fulfilling this definition of investment company. And here the words to any investment made by investment company. Supposing you are an investment company you cannot extend this exemption for the loan transactions of this investment company, because what is exempted only investment transactions for this investment company. If your investment company is giving loan, giving guarantee and security, you cannot extend this exemption, and it is exempted only and only for investment transactions of an investment company. The next is about shares. You're making investment in the shares of another body corporate by virtue of rights issue. Supposing you are being offered, you are holding shares of a company and you want to make further investment in that company with, by virtue of rights issue. Again, here there is a complete exemption. And unlike WS, where I said the exemption is only from shareholders resolution, because here it falls under blanket exemption, because the opening lines of these exemptions 186.11 say nothing in this section except subsection 1. So whole of that provision, that is board approval, shareholders approval, limits, rate of interest and register, whole of that provisions of 186, 2, 3, 4, 5, 6, nothing will apply in case of making investments in case of rights issue. Lastly, the last exemption is about NBFC companies. If NBFC companies are also exempted from their investment activities, provided again their business is of make investments, acquisition of securities and so on. So government companies which are engaged in defense sector, this is not applicable. Other government companies other than the listed company, 186 is not applicable, provided they are regulated. It is in consonance with the approval of their central or state government. IFC companies also have certain exemptions, and so is Section 8 companies. So a little critical points of 186. We have discussed 186 largely. But just to clarify a little more, there are two conditions in case of 186. Firstly, investments under 186. Firstly, it should be investment in securities. Securities, we know that is defined under the SCRAS. What is the meaning of security? And secondly, says it should be investment in bodies corporate. To examine in a particular transaction whether 186 is applicable or not, you should check whether these both conditions are being met. It should be investment in securities and it should be investment in bodies corporate. So let's take an example. If my company wants to make contribution towards LLP, right? So whether the investment contribution in LLP will attract Section 186, whether it will attract Section 186. So LLP is although a body corporate, but investment in LLP will not contribute securities, and hence it will not, and hence 186 will not be applicable. Guarantee and security in connection with the loan. Again, I said while explaining that guarantee and security is allowed only in connection, is restricted, and 186 applies in connection with the loan. So if your company is giving guarantee or security which is not in connection with the loan, say let's say performance guarantees, okay, then again 186 will not apply. So important point here again is that whether you need entity-wise shareholders approval under 186, when you're taking shareholders approval under 186, whether you need entity-wise approval, meaning that do you need to mention in your resolution, special resolution, the name of the entities whom you want to make investment, give loan? No, it is not required. You can take approval of shareholders. Blanket means not blanket without mentioning any amount. You don't need, only thing is that you don't need to mention the name of entities. You can mention the limit up to say 5,000 crore, but without mentioning even the amount is not okay. Then we discussed about LLP. We have already discussed loan to trust. Where if my entity wants to give loan to trust, whether 186 will apply? Yes, it will apply, because trust is any person, right? While giving loan to person is also covered. Although we all know that trust is not a body corporate, even if it is not a body corporate, but it is a person. Because any person is covered, loan to trust will also get covered. Loan by holding company to foreign subsidiary, right? So we all know the interest rates in foreign jurisdictions is very low as compared to Indian rates of interest, right? It is maybe 2%, 1%, and 3% depending upon the jurisdiction. So many a times we come across this question that I want to give loan to my foreign subsidiary. if this foreign subsidiary had to take loan from the foreign bank, it will give, say, let's say, assume at 2%. So because it will get from their jurisdiction and from foreign bank 2%, can I give also loan to my foreign subsidiary at 2%, which is much below GSEC rate? The answer is no. There is no such exemption. If your foreign subsidiary wants to take loan at 2%, it has to then take it from the local sources only. You being covered by Indian jurisdiction, by Under Companies Act, you cannot take this argument that it is my subsidiary, it is arm's length. Had it been taken loan from foreign bank, it would have got 2%. And so I can also give at 2%. No, that is not allowed. Whatever is your subsidiary, Indian, foreign, etc.
Same thing had happened, her battery got discharged, and that's why. In the meantime, Bala, if you can, any questions are there, we can take up that.
Yeah. Can a loan given to a subsidiary for the repayment of the loan taken by the subsidiary? That I think we have seen this. Can a lender company give a loan to the another company from the borrowed fund? That also I think we discussed.
The only thing is income tax point of view, one has to see that. Private Companies Act point of view, there is no issue as such.
For a private limited exemption, as per the exemption notification, the point says the private company in which no other body corporate has invested. Does it mean company having a body corporate shareholder? Or does it mean company can have only one body corporate shareholder, but not more than one?
No, any body corporate shareholder, they have used the word.
If board has power of rupees 100 crores under 181C, whether the board can delegate the 100 crores powers to the committee of the board.
Yes, why not?
They can delegate.
Yes, they can do it. Yes, yes.
Yeah. Only thing is the limit should not exceed beyond that. That's it.
Correct.
Okay. Dear man. So the more than the 2 layers company's prohibition is only to the investment company or any other company.
Only investment, 186 only investment company.
Yeah, it is only investment. She said very clearly. My company is investing in the mutual funds. Do we require approval under 186?
Not required.
Is there any difference between intercorporate deposit and loan? In case of ICD, section 186 applicable or not?
Yes, it is applicable.
For calculating 60% negative balance of P&L should be deducted from share capital?
Not required because it is not net worth. You have to deduct the carry forward losses only while arriving at the net worth of the company. But whereas here it is, if you have share capital, if you have free reserves, you have to take that. You don't need to net off that.
Whether preference capital also to be included in the paid up capital?
Yes, preference capital is also a part of share capital only. If you see the share capital definition, it includes preference share capital.
Hello, ma'am. My query is related to the applicability of the section 185 on a particular arrangement. Suppose Mr. A is the director in the P Limited. P Limited wants to give a guarantee to Q Limited on behalf of Mr. A. However, the guarantee given is not in connection with any loan taken by Mr. A. Now, as per the section 185(1), no company shall directly or indirectly advance any loan, including any loan represented by a book debt or by any guarantee or private any security connection with the way taken by. So, any director of a company, query, if the guarantee is given by a company on behalf of any director, is it not against the loan taken by the director and against any other arrangement will section 185 apply?
Bala, you may answer the question if you feel like, because I don't answer these kind of questions in webinars.
No, then in which case let us leave it. Because as you rightly say in the beginning, it is more of the personalized questions.
Yeah.
Whether the loan given to the KMP, who is also employee, also exempted from section 186.
Yes, it is exempted.
From where to find the GSEC rate of interest?
You can find from RBI website. Or even any investment bankers or something like that also. I think Anshu, she came back.
Yes, sir. You rightly said it can be found out from RBI website.
Correct.
There are websites where we can find out.
If a loan made by the holding,
yeah.
If a loan made by a holding company to a subsidiary company becomes impaired, and the provision is made in the books of the accounts or mandatory provision loan of the impaired loan pursuant to section 186 of the Act.
The question is not clear to me.
He says, if a loan made by a holding company to its subsidiary company becomes impaired.
Impaired means what? Impaired means what? It is. It is, they're not repaying the loan, they're not repaying it back. What is impaired? Impairment of asset, I can understand. Impairment of loan means what?
Sanjay, are you there? Sanjay, are you there?
So anyway, that Bala, what we'll do, we'll take this particular question at the last. Let Anshu complete her presentation.
Okay.
Okay. And then we will take it in the last. Yeah, Anshu, please go ahead.
Yeah. Sorry, I had got disconnected. So just to begin from where we had left last. So we were discussing about loan to foreign subsidiaries. One important point again here is that, nowadays, most of the companies follow Ind AS. So when you prepare your financials as per Ind AS, most of your investments as in line with the requirement of Ind AS are showed in your balance sheet as per fair value, right? Let's take an example. I have made investment in the NCDs of HDFC Limited, example, right? So as per Ind AS, and I have made 1,000 rupees investment. In line with Ind AS requirement, this might be shown in your balance sheet, maybe 2,000 rupees or maybe 800 rupees, depending upon it has what is the fair value at the time of 31st March 2023, for example. Maybe it has given you appreciation, maybe it has NAV has gone down. So you would show, say, you had made a repeating 1,000 rupees investment, which is currently shown in your balance sheet as 2,000 because of the fair value requirement. So what will you take into account while calculating what is your already made investment? We need to calculate, right? While we are deciding whether we are 60 or 100% limit, you need to take into account all your existing investments along with the proposed investment, right? You need to accumulate all that to see 100% and free 60% limit. So point of clarification here, in these cases, please don't get confused with the amount which is shown in your financials. That is a fair value amount for all your accounting purposes, for your financial statement purposes. Please go back to your accountant and ask for the actual amount that has been invested by the company. In my example, 1,000 rupees. Because if you take such value, supposing the NAV had gone down and it was shown as 800 instead of 1,000, you would have taken 800. And whole of the calculation, your base of calculation would be wrong. So generally it happens, at least in my case, it happens whenever you ask your accountants, okay, give me the, give me money calculation. So give me the amount of existing investment. They are bound to give you the value which is they have taken for accounting. And you need to go back and clarify, no, I need this particular amount, which was actually made by the company, and I don't need the fair valued amount. So very important, I think, here.
As you rightly said, in fact, your presentation of the financials in the balance sheet or profit and loss account is different, because sometimes even the preference shares, okay, your preference capital, you may have to show it as a borrowing. That doesn't mean, it is not having the nature of capital. Preference share capital, as per the definition of company side, it is a part of capital, not of borrowings. But when you are preparing your financial statements as per Ind AS, the presentation may be in a different way. So what you say?
You're absolutely right, because Ind AS says actually the preference share is nothing but a long-term capital. It is only for the presentation purposes. But when it's come to the company side, it is already a paid up capital.
Yeah.
Similarly, similarly, because taking this example of preference share, because it is shown in your Ind AS as other equity and not as part of capital, does not mean that you don't have to take as part of paid up capital while calculating paid up capital. For all our companies at compliance, it's very much a part of your paid up capital.
Not only that, even in Ind AS, when we are preparing it, the dividend which is actually payable on the preference share capital is also actually shown the charge to the P&L account, because it is already a committed one. But that does not mean, under the Companies Act, the dividend declaration, we need to take the approval from the shareholders. Unless the shareholders' approval is taken, the money cannot be actually paid under the Companies Act. Although for the presentation purposes in days, the preference share capital will be shown as a long-term borrowing, and again the dividend payable is shown as a charge to the profit and loss account. Still, when it comes to the Companies Act, the treatment is different, as you rightly said.
Yeah, very important point also here is that while we discussed that the 186(2) allows you to take blanket shareholders approval with, of course, goes without saying that there has to be caps on the amount and etc. Does not mean that blanket does not mean that without any limit. What it only means is that without mentioning the name of every entity. But when this 186 has come in place of 372A, they have given this flexibility of not giving the name of entity in the shareholders resolution, which was the requirement under 372A. But at the same time, a provision was added that you need to give details of such all loan, investment, guarantee, and security in your financial statement. So every year's financial statement needs all the details of all the loans, investment, guarantee, and security given by the company during the year needs to be necessarily disclosed in your financial statement. Sorry, but I have observed that this is a generally violated provision. Most of the companies are not in compliance of this. So please take care of this particular provision. It's a very important provision. More in particular, because 186 is a non-compoundable section. Non-compoundable. So you would have seen that when the amendment came in, most of the sections in the Companies Act, fines have been replaced with the penalty, right? In 185, 186, they have still retained the word fine and not replaced with the penalty. Because the regulators still feel that these are very important provisions and this cannot be just replaced with the penalty. Because what is the meaning of penalty and fine? I'm not getting into it at this moment, but there is a reason that why I have still retained this section, still have the meaning word fine instead of penalty. And there is in these sections, because there is the 186 especially is a non-compoundable section. And so this is a very important point, I think, is that we need to understand each and every point, and this particularly financial statement disclosure is missing in all the companies.
And one more important point, Anshu, is that as you rightly said, in case of shareholder resolution, you can take a blanket approval for investments or loans and other things. But whenever you are making any specific investment, that should be supported by a separate board resolution. Sometimes people think that there is one school of thought that they say even the investments also, the board also can give a blanket resolution and you invest up to 1,000 crore rupees. No, it is not correct. If you see that 186 subsection 5 clearly says that every investment or every loan, every guarantee security, that is to be supported by a board resolution.
Yes, very right, sir, because although we get confused, like 179, which also deals with authority to make investment, and it allows it gives the authority to delegate. So we feel that because 179 authorized you to delegate, we feel that is also okay under 186. But as Sudhakar sir pointed out, because of the wording in 186(5), it says no loan and investment guarantee shall be made without the unanimous consent of board approval. The view is
the only difference between 179 and 186 is that 179 you don't need to pass a specific in which security you have to make how much investment, that is not required. 179 for making investments, you can take a blanket resolution. That's why for mutual funds, when 186 is not applicable, you can take a blanket resolution up to X amount of crores, you can make an investment. Then you can delegate it. Similarly, in 186 also, no doubt about it, you can pass the board resolution and subsequent, if you want to delegate, you can delegate it. How it is, I will give an example. Say, for example, you say that the board hereby approves an investment of rupees 1,000 crores in XYZ Limited in one or more tranches. Okay. And to make that investment, to take that decision and to decide the terms and conditions, blah, 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 and all those things, then you can delegate the power. That is permissible under 186 also. So the fine difference between 179 and 186 is whenever you are lending the money or whenever you are making investments and all, you have to be specific, which is not so in case of 179.
Right. So, again, a point here, when I was explaining about disclosure in financial statement, again, here a word of caution that you don't disclose the fair value amount. If you want to disclose fair value amount while disclosing in the financial statement, fine, but you also need to necessarily mention about the actual outflow amount. In addition, you want to mention fair value, it's fine, but don't miss to mention, disclose the actual outflow amount or actual guarantee amount. Can a subsidiary company give loan to its holding company? While discussing this, we discuss while discussing 185, we discuss about this point. Again, 186, there is no restriction that subsidiary cannot give loan to its holding company. Subject to compliance with 185 and due compliance of 186, you can give loan, subsidiary can also give loan to its holding company. Important point again, 186 is that, time and again I've been saying that guarantee and security in connection with the loan is the wording under 186. So in that connection, if you are providing guarantee and security in connection with the non-fund based facility, what is non-fund based? LCBG and so on. So if you're providing guarantee and security in connection with non-fund based facilities, is there a requirement to comply with 186? So I would say, if you are not available, if not complied 186 and say, let's take an example, your subsidiary is taking loan from Kotak Bank and towards taking this LC facility or BG facility from Kotak Bank, and you are providing, the holding company is providing security for this LC or BG. And you are not taking board or shareholders approval, assuming that, no, this is not in connection with the loan. But if tomorrow, if there is a default and takes a color of borrowing, in case of default, then how will you comply with that section? And in my view, to avoid any such issues, even in case of non-fund based facilities, approval of board and shareholders, if it is applicable, like shareholders approval, etc., should be taken right at the beginning. Sudhakar sir already explained about whether there can be delegation under 186. So we have already dealt with this point. He has also mentioned very clearly about mutual fund and why mutual funds are out of section 186, because most of the mutual funds construct is they work in the trust form. They are not bodies corporate, and hence most of the mutual funds investments in generally are out of section 186. We also discuss about LLP. We also discuss about trust, that although trust is not body corporate, but because if you're giving loan to a trust, a person is also covered in while giving loan, and giving loan to a trust will also covered under 186. Lastly, punishment provision. I told you that this is a non-compoundable section, and of course there's a fine, still not replaced by penalty. There's fine as well as imprisonment, and not being an offense punishable with imprisonment only or punishable with imprisonment and fine. This makes this section as a non-compoundable section. Just a quick points that while checking compliance of 186, check that you have not breached the limits. It needs to be checked not at the beginning of the year. It needs to be checked at each and every transaction level. When you are making these transactions, you need to check these limits. We discussed that it has to be unanimous consent of the board has to be taken at the meeting. Circular resolution is not allowed. For every such transaction, board approval, MTT 40 needs to be filed. Shareholders approval, depending upon the limit. PFI approval, public financial institution, which is a defined term, needs to be taken depending upon it is triggering this requirement of PFI or not. Rate of interest, we discussed that corresponding to the tenure of loan and GSEC security interest, the loan GSEC interest rate needs to be charged. There was one clarification of MCA on this point, that in case of tax-free bonds, where there is no when you are making investment in a tax-free bonds and you don't get year-on-year returns. Okay, so then whether it is in compliance with the interest rate requirements of 186, there is the MCA circular that if at the end of the tenure, you are giving the particular yield from that investment is particular to the GSEC rate returns, then it is a due compliance. We discussed about the disclosure in the financial statements. And apart from the particulars of what the amount and etc. company has made investment, it is important to mention what is the intended utilization by the recipient. I missed mentioning this earlier. What is the intent that recipient is going to use that loan for, that also needs to be mentioned in the financial statement. And we need to ensure that while before making any transaction, there is no default on account of deposit or interest thereon. And while if you're giving loan to your related party, if your party you're giving loan, making investment happens to be a related party, you also need to comply with section 177 and 188. I mean, you cannot say that I'm complying with 186 to 177 and 188 is not applicable. These are because of investment transactions and so on. You need to examine if 4, 5, all the sections, whichever is applicable to the particular transaction, each and every provision in every section needs to be complied with. So in this case, if it is a investment or loan to a related party, 177 and 188 also needs to be looked into. That's it from my side. Thank you.
Thanks a lot, Anshu. You touched upon very, very nicely. As you rightly said, when we are looking at it, we'll have to look into the compliance of section 179, 186, 185, and 188. We need to look everything wherever the compliance is required, all the compliances to be made. Let us look into the questions here. I think the loan matter, what he was talking about, impaired. He says it becomes a bad debts. That's what he is saying. The loan is made by the holding company, the subsidiary company becomes bad debts, and the provision made in the books of accounts. Is it mandatory for the loan for the impaired loan pursuant to the section 186 of the Act?
No, as far as your limits are concerned, you will not consider bad debts. You will not eliminate that. That if that is the impairment, that is not to be taken into account.
Okay. If a loan is made by the holding company to a subsidiary company, that we have seen, I think so.
And so when you got disconnected, I could answer some questions, and that's why not many questions are left for you.
Okay. Yeah, you made my job easy, sir.
Whatever it may be, I don't know. I think if there are no questions, we can wind up. Bala, it is already 1:15.
Yeah, I know. 1 minute. Let me see this.
Sure.
If a loan made by the holding company to a subsidiary company become impaired, that we have seen, I think. Yeah, after that, I don't see any questions.
Great.
Yeah.
Dipti, you're there?
Yeah, I'm there.
Yeah, you can wind up then.
So we can close the session, Dipti.
Yeah, I was thinking that still it is going on, the question answer.
No, we are done with.
Okay. So now thanks. It was a very interactive session. Thanks a lot. Anju, thanks a lot for your time. All the participants, thanks. Sudhakar, thanks for your time. Thanks.
Thank you, ma'am. Thank you.
Anshu, I must personally thank you so much, because definitely lot of things I got clarified today in the current situation with the amendments, etc., which actually came out. So really speaking, it was a really a knowledge enhancing session. And we can also see, even at this time also, there are almost about 100 participants are there. It shows the importance of this particular topic. Good interaction, good knowledge addition. Thanks a lot. You have done excellently, very well in this. Your preparation was excellent. I must personally thank you so much.
Thank you, sir.
Thanks a lot, Sudhakar, for your support.
Thank you, sir.
Thank you very much, Anshu, for accepting our invite. Thank you.
Thank you. My pleasure.
Thanks, Anju, for all your practical sharing experience. Thanks.
Thank you.
Thanks a lot
Thanks,
to everybody,
everyone.
all
Bye.
the participants. Have a good day. Have a good weekend.